This century-long trajectory shows the persistent growth of the stock market. The red clusters overlaid on the line map the exact points where retail investors historically exited their positions, locking in massive capital losses right before the trend recovered. These massive losses are the direct result of the raw survival instinct sitting inside the investor's own skull. Biologists refer to this as the evolutionary mismatch. The human brain spent millennia optimizing for immediate physical survival on the savanna, a process that left it ill-equipped for the delayed rewards of modern asset accumulation. When your brain registers a sudden drop in a portfolio, it processes the red data point through the same neural circuitry used to detect a physical predator. Building wealth requires a deliberate effort to override this ancient programming. Left unmanaged, your internal biology will prioritize short-term safety over long-term growth every time. The physiological reaction to a falling market occurs in milliseconds. The amygdala pulses red the moment you see a market dip, flooding your nervous system with cortisol. This is amplified by loss aversion. The neural pain of losing money is twice as intense as the joy of gaining it. High cortisol levels create a state of intense physiological friction, a physical discomfort that radiates through the chest and stomach. To end that physical distress, investors hit the sell button at the bottom of a market dip, trading their long-term capital for immediate physical relief. While the relief is instantaneous, it comes at the cost of the compounding interest that would have accumulated over the following decades. This behavior represents a biological survival reflex, functioning exactly as intended, but applied to an environment where it is counterproductive. While fear drives the panic, modern 24/7 financial apps are intentionally designed to exploit your brain's reward centers. Refreshing a portfolio hijacks dopamine receptors, training the nervous system to demand a cycle of instant gratification. This dopamine loop suppresses the prefrontal cortex, the area responsible for logic and long-term planning. This effectively hinders your capacity to prioritize future wealth, worsened by the availability heuristic, a cognitive shortcut where recent dramatic events, like a market crash, overshadow decades of objective data showing the market's historical growth. Social media algorithms amplify these fears by surrounding users with confirmation bias, triggering a biological urge to follow the herd. This combination of dopamine-driven app usage and digital echo chambers severs the investor's connection to objective financial reality. You cannot erase evolutionary history, but you can reorganize how your brain responds to it. Through neuroplasticity, we physically thicken pathways in the rational brain. When an investor remains still during volatility, logic circuits strengthen. Once reinforced, these pathways lock together into pre-commitment strategies, manual bypasses preventing emotional pulses from influencing decisions during market turbulence. Financial automation serves as the primary tool to support this new neural architecture. Automating your contributions removes the need for manual execution, ensuring that the amygdala never views a recurring investment as a threat that needs to be assessed. These deliberate, mechanical habits are ultimately the most reliable method for neutralizing biological threats to your long-term capital. Success requires a shift from reactive survival to probabilistic thinking. This mental state allows elite investors to remain detached from short-term fluctuations, viewing market movements through the lens of mathematical probability rather than personal loss. Through this lens, market volatility is simply a period where assets are temporarily priced at a discount. In a global economy defined by high-speed data, the most valuable edge is the ability to govern your own internal biology.